In this video, we are going to focus on two examples to illustrate the application of various new VAT principles applicable to grade 12 work. So first we are going to perform the calculation of VAT payable to or receivable from SARS. Pizza Traders is registered for VAT on the invoice basis with a category B tax period. We know we have all these various tax periods. You have those vendors that have a 1 month period, those that have a 2 month, those that have a 6 month, a yearly one, etc. All the transactions of the business are subject to VAT at 14%. We know these days it's 15%, but the principles are the same. It is only the rate that differs. The following information was taken from the books of Pizza Traders on 30 April 2018. So we are given a summary of the transactions of Pizza Traders for March and April, because we know category B is the 2 month period. So we are required to calculate the amount of VAT that Pizza Traders will need to pay to or can claim from SARS for the 2 month period ending 30 April 2018. So now we have a bunch of all the transactions. In some cases we are given the amount including the VAT, in other words the 100 plus the 14, the 114%. Sometimes we are just given the amount excluding VAT, in other words the 100%. So now the first step is to categorize all of these transactions. We know some of them will be output tax. Output tax is when what we owe SARS increase, that is when we render a service or sell products. Then we have transactions that will give rise to input tax, that is when we purchase goods or services from registered vendors. And then we have a new category in grade 12 that we refer to as VAT adjustments, which fall in neither of the first two mentioned categories of input and output. So we will still focus in more detail on that and explain as we go along. And then we know there are certain items that no VAT is applicable on. So first step, let's categorize. So sales of goods is an output tax. Purchases of goods will be an input tax. Salaries and wages, VAT is not applicable to that. It's not subject to VAT. Rent income is an output tax. Equipment sold is an output tax. Goods taken by owner for personal use. Now that one doesn't really fall into input or output, so that's a VAT adjustment that we will discuss in detail. Goods returned by customers, similarly a VAT adjustment. Goods returns to suppliers also don't fit in input or output, so it's a VAT adjustment. Interest on loan is an exempt item. We do not pay VAT. Telephone, electricity and insurance is an input tax as we obtain it from a registered VAT vendor. Discount allowed to debtors, not an input or an output, so it's a VAT adjustment. Similarly, for discount received from creditors, debt written off as irrecoverable, also a VAT adjustment. Consumable stores purchase, yes, from a VAT registered vendor, we have an input tax. So now that we have categorized everything, let's go ahead to calculate our VAT payable or receivable. So we will have to obtain all our output taxes and add them up to see how much we owe SARS. Then similarly we have to calculate all our input taxes and add them up to see by how much we can reduce what we owe SARS. The difference between what we owe SARS, the output tax, and the input tax will give what is payable to SARS if output tax is more than input tax. If the opposite is true and input tax is more than output tax, SARS will owe us. So let's first focus on our output tax. So the total sales of goods is an output tax. We see it's in the inclusive column, so it includes the VAT, so it's the 100 plus the 14%, so this is 114%. So if we are interested in only 1%, we can divide this 433,200 by 114. Now that we have 1%, we want 14%, so multiply that answer by 14. So divide by 114, multiply by 14. So we have the 433,200, we multiply by 14, we divide by 114, and we obtain 53,200 Rand. So let's find our next output tax. It's the rent income. It is again an inclusive amount, so we will divide by 114, multiply by 14. So rent income, multiply by 14, divide by 114, we obtain 2,800 Rand. The next output is the equipment sold. In this case, we are given the inclusive as well as the exclusive values. We know the VAT is the difference between the two, so we have to subtract the 12,000 from the 13,680. That will result in 1,680 Rand. Okay, it doesn't seem we have any more output tax. Now let's focus on that new category that we refer to as VAT adjustments. Because certain VAT adjustments will have the effect of increasing, in fact, our output tax. Okay, so firstly, we have goods taken by owner for personal use. Now, originally we had to purchase these goods from a supplier. Now, if that supplier was a VAT vendor, it would have resulted in an input tax. But now, since this was not used for business purposes but for private purposes, that input tax actually should not have occurred. So now we will have to reverse it. That's why we have a VAT adjustment. So the opposite of an input tax is an output tax. So to cancel the effect, we will have to have an output tax. So the amount was 5,900 excluding VAT, so we will still have to calculate the VAT of 14% and add it to our output tax. So we have the 5,900 times the 14%, and we have now an output tax of 826 Rand. Okay, so let's look at the next one. Goods returned by customers. Let's think a bit about that one. What would have happened originally? We would have sold to the customers, so it would have been an output VAT, but now they return it, so now we can't, so we can't now still get the benefit or not the benefit rather, SARS can't get the benefit of that output tax, so we will have to reverse it with an input tax. So we'll deal again with it when we get to the input tax portion of our calculation. But now goods returns to suppliers, that will definitely be an output VAT adjustment, because we originally purchased from a VAT vendor. It would have been an input tax that we claimed, but now when we return the goods to the suppliers, we can't still get that input tax. We will have to cancel it. So the opposite of an input is an output. So now they give us the inclusive and exclusive. We can simply get the difference. That will be our part of our outputs for this VAT adjustment. So the goods returned, we subtract the two amounts to get 1,232 Rand. So let's see, where's our next VAT adjustment? Discount allowed to debtors. Let's analyze what originally would have happened. So we would have sold to our debtors. So it would be an output tax for us originally. Now our debtors pay us early, so we allow them a discount. So that output tax that we raise is now too high. So therefore we will have to reduce it. So the opposite of our output is an input. So we will have to adjust our input tax. So we'll focus again on that when we deal with the input tax calculation. The discount received from creditors is obviously just the opposite situation. Originally, we purchased from our creditors. We have this input tax. Now we pay early. So now our input tax originally was too high, since we now pay a lower amount. So we will have to do the opposite. It will result in an output VAT adjustment. In this case, we are given the exclusive value, so we still have to calculate the 14% on the 7,200 Rand. So 7,200 times 14 over 100 gives us 1,008 Rand. And now we are in the position to add up all our output taxes, and we get an amount of 60,746 Rand. So let's now focus on the input tax calculation. So in terms of input tax, we have total purchases of goods. We are given the exclusive value, so we can still calculate the 14%. So it's the 165,000 times 14 over 100, which gives 23,100 Rand. Okay, so we also have a VAT adjustment that could affect the input tax. You know, the personal use one was an output tax. We already dealt with it. But this goods returned by customers. If we go back to the original transaction, we would have sold to customers and have an output tax. But now they return some of it, so it is as if some of the goods were not sold. So our output tax was too high. We will have to do the opposite, namely an input tax for the difference between the exclusive and inclusive amount. So on the goods returns by the customers, we have an input tax adjustment of 2,310 Rand. Goods returned to suppliers, that's the opposite. We did it already as a output VAT adjustments. The discount allowed to the debtors, So let's just quickly analyze what originally happened. We sold to our debtors on credit. There would have been an output tax. Now they pay us early, so that output tax was too high, therefore we will have to do the opposite, namely an input tax VAT adjustment. We are given the inclusive VAT, so it's the 114%, so we will have to divide by 114 to get 1% and then multiply by 14 to get the 14% percent. Okay, there we go. I see we skipped one. Let's just go back. It was an input that we missed along the way. Yes, telephone, electricity and insurance. Again, it was an inclusive amount, so we will have to divide by 114 to get the 1%, multiply by 14 to get the 14%. So that was that in between one, telephone, electricity and insurance, which will result in a input of 1064. And then let's look at this debt written off as irrecoverable. What was the original transaction? Well, we would have sold on credit to our debtors, so that would have been an output tax. Now they actually don't pay us, so we are not going to benefit SARS. We are going to say we are going to pay you definitely less money, so we will raise an input tax adjustment, which will be 14% on the 18,400. So let's go quickly back. Why did I say 14%? It was actually the difference between the two. They already gave us the two amounts. I looked at the wrong one, consumable stores. Okay, so now that we have corrected that, we can see it's the difference between the two. It's the 462 Rand. And then finally, we have the consumable stores purchase, which is a normal input tax. We have the 18,400, we have to calculate the 14%. So 14% on the 18,400 simply results in 2,576. We can now add up all of these input taxes, and we obtain 31,402. We see our input tax is less than our output tax, so we are in fact owing SARS the difference. So the VAT payable to SARS in this case will be the 6746 minus the 31,402 for a 29,344 Rand. Now, something very important. These VAT adjustments that we included as outputs, you could just as well have included them as inputs. The only difference is instead of positive amounts, it would be negative amounts, because an increase in output, the opposite of that is in fact a decrease in input. So these VAT adjustments are included as output tax, but could have alternatively been what we refer to as set off against input tax. We are going to show it in the next slide. Similarly, these input ones we could have rather deducted from our output. We could have set off against the output tax. We will also show this in the next slide. And we know if the total input tax was more than the output tax, we would have rather a VAT refundable by SARS to us. Okay, so I'm now not going to go through the details here. I just want to show you that the ones that these three VAT adjustments in the previous slide was part of the input taxes as positive values. Now we just have it rather in the output section as negative ones as indicated by the brackets. And now we will get a different output tax amount. Similarly, these items, these 1, 2, 3 items were previously output tax adjustments, positive ones. Now we just include them rather as input ones in brackets, therefore as negatives. And we will get a new input tax amount of 23,674. But if we subtract from the output the input, we will get exactly the same VAT payable to SARS amount. We can also perform this calculation using a combination of the two methods of accounting for VAT adjustment. So you could, these three that are in brackets, maybe this one you include it as a positive in output tax. And maybe of these three that are in brackets in output tax, you decided now rather we'll treat one of these as a normal input tax. So it still won't make a difference to the end result. Your VAT payable or receivable to SARS will be correct. So you can even use a mixture of the two approaches.